Hey everybody, welcome back to Two Guys Talkin Houses. I'm Stephen Barnhill.
And I'm Marc Elliot.
And guys, you may have seen that we changed up the venue. Two Guys Talking Houses is now taking place in one of the guys' houses. Marc here, thank you for allowing us to use your beautiful home for the set. Guys, today we want to talk about interest rates, and specifically the Federal Reserve meeting, the last one of the year that's coming up on the 18th of December. A lot of people are anticipating that the Federal Reserve will reduce the federal funds rate, but we want to kind of cater the topic of the conversation around, should you hold out to buy a house waiting for rates to come down? And what are some of the things that you should consider if you're trying to weigh those options in your mind? Is it a good idea to buy now? Is it a better idea to wait and see where rates are next year? So Marc, I want to just jump into it with your thoughts. You know, what are some of the pros and cons as a lender that you're seeing when you get clients that call you and say, hey, I want to buy a house, but I want to wait till next year when the rates come down?
The first thing I want to say is that what I always say, like, the best time to buy real estate was 20 years ago.
Yep.
Second best time's right now. You know, and it's going to kind of always be that way, right? Because they're not making any more of the stuff. You know, God made a finite amount of earth. Yeah. So, you know, once it's all gone, it's gone, right? And then it's just who wants to pay more for that piece. So when people are calling me and saying, hey, I'm going to wait, you know, for the rate to come down, you know, often I'm asking them, well, what kind of rate are you looking for?
Right.
You know, are you looking for zero? Because, you know, they don't really do that. You know, they got low, 3%, right? So, but that set of circumstances would be almost impossible to have occur again.
Sure.
You know, so we're not going to see that in our lifetime for sure. But, you know, are they looking to come down to, you know, 5 instead of 6 or 6 instead of 7 or whatever it is? You know, what's the cost of waiting?
Right.
You know, what are they missing out on? And, you know, and I know you see this in your day-to-day life, your day-to-day work, you know, as the market heats up, it becomes less likely that you're going to get as good a deal.
Yeah, well, that's exactly right. And that's what I always tell my clients to weigh. Because when interest rates are super low, there tends to be just a frenzy of buyers in the market. And that's a great thing if you're a seller, maybe not such a great thing if you're a buyer that's trying to get a deal on a house. And I think that we have to look at what happened in 2020 and 2021 as sort of a double-edged sword. Yeah, it's great for the people that have a 2% interest rate and a 3% interest rate, but how much over the real valuation of that home might they paid, you know, just to get the privilege of getting their contract accepted? You know, as you saw as well as I did back then, you would list a home for $350,000, and by the end of the day, you'd have a half dozen offers, and you would need to be darn near 400 to get your contract accepted. So yes, you do have the benefit of that rate at 2.5%. However, you may have overpaid for a house in the process.
Right.
So, you know, there's that's the two sides of the coin that you really need to consider when you're thinking about where you want to make your move.
And you know what's great? We don't even have to go back that far.
Yep.
We just have to go back till after the July Fed meeting. You know, at the end of July there, they had that July Fed meeting. They didn't cut rates. Everybody knew it was coming the next time.
Big one's coming, yeah.
Big one's coming. And so, you know, mid-September, they dropped them. Well, in between there, rates came down, right? Yep. And we were, you know, rates historically have gone, they've gone from 6 to 7 to 8 to 7 to 6. They went to 6 during that time. And what happened? We all saw a huge increase in mortgage applications.
Yep.
We saw a huge increase in traffic, and we saw less seller contributions to closing costs. We saw less negotiations because it was just a taste of what it would take to get this real estate market to take off again.
Yeah, and that's the thing too, is you mentioned the seller contributions towards the closing cost. There's a lot of factors when you buy a house. It's not just what's the purchase price. The purchase price is one factor in the equation. Yeah. There's a lot of other things that you need to negotiate. You know, Are you going to have an option period where you have a 7 or 10 day period of time to terminate the contract for any reason? You know, maybe you look at the inspection report and the inspection report's not great and you want to terminate for that reason and not lose your earnest money. Maybe you want to ask the seller for some repairs. Maybe there's some foundation issues and it's going to cost $10,000, and you could very, respectfully ask the seller to cover all or some of that. So these are the sorts of things that you see when there's a more healthy market. And I think, and correct me if I'm wrong because you do loans and I just sell houses, but when you're looking on your side of these deals that are coming across your desk, what is the sweet spot interest rate wise where you would say that it's a healthy market, where the sellers aren't just getting hosed with tons of concessions and tons of repairs, as well as, the other side of that, which would be buyers having to way overextend themselves and overpay for a home? What interest rate, if you can pinpoint an interest rate, is the sweet spot where it's kind of a 50-50 playing field for buyers and sellers, if that makes sense?
Yeah. And, it's we have plenty of economists and plenty of experts that handle all this research for us, right? Yeah. I went to economics class many times in college, but general consensus is about 6.
Yeah.
I mean, once we get to a 6 or something with a 5 in front of it, even if it's going to cost a little bit to buy that rate down, that's when we see the market pick up. And so I think 6%, low 6s even, 6.25, somewhere in there, is enough of a trigger to get the market going without, over blowing up, we'll say. And making, although, part of the problem right now is we do have a lot of pent-up demand.
Yes.
We have a lot of people sitting there saying, I'm going to wait because Google told me to. Or I'm going to wait because, we're going to get 3% again.
Or my favorite is my uncle told me rates are coming down next year and the real estate market's going to crash. So I'd be a fool to buy now.
Right, exactly. I don't know who your uncle is, but I don't know. And we run into that all the time. There's these common beliefs out there. And when you really look at the numbers, now is actually a great time to buy. Yeah. If somebody waited a year, so let's say they're looking at buying a house now, they waited since the last time they looked a year ago.
Right.
What do you think, as a percentage of that price, what do you think they're paying more now than they would then?
Yeah, 3 to 5% probably in our market at least. And so this time last year, where were rates as compared to where they are now?
Gosh, I mean, 7s.
7s. So we're in 6 now, 6s, and what's it? Today's going rate, high 6s?
High 6s. So the national average, 6.91 on one of the indexes we follow, on a 30-year fixed rate mortgage, and sometimes that's even with a little bit of a buy down.
So essentially, I guess what I'm getting at here is, if you decided last year this time to wait a year, you're essentially at the same place you would be. The interest rates are give or take within a couple of points of being the same.
Yeah.
The house is probably 3 to 5% more expensive.
Right.
You have now incurred another year's worth of rent, which if you're living here in Texas, where rent's not exorbitant compared to some places, it's still very high, you're probably at minimum 25, 30 grand out of pocket for rent, which is only helping the person pay down the mortgage, only helping the landlord pay down his or her mortgage. So, you would have made out, if you do the math, if you would have bought last year, absorbed the 7% interest rate, assuming that it fits within your debt to income and the comfortability that you have at that price. And I always want to caveat that, because I don't think that you should, I think buying a house is a real blessing and everybody should look to do that. But you also should be careful not to overextend yourself because you have house fever. But if a 7% interest rate with your down payment, the tax rate in the area, the insurance quote, everything fits, and the monthly estimated total payment fits within your budget, it's a good time to buy at that point in time, no matter what the rate is, because it's affordable to you. And it's never going to be less affordable, because if rates come down, you always just refinance the loan. And if you are comfortable with the payment at a 7, you should be very comfortable with it at a 5.
Right. And there are ways right now to make those rates lower. There are the temporary buy down programs.
Yeah.
So let's touch on that for just a second, because it ties in with what you're saying about don't overextend yourself, right? I often tell people, you know what? Yeah, you could qualify for $1 million house, but if you don't want to make $1 million payment, it doesn't matter.
Exactly.
We're going to find you a $200,000 house because that's the payment you're comfortable with.
Right.
But some of the programs out there, and we have them, just in full disclosure, we have a temporary buy down program that makes the rate, I don't know, 2% lower the first year and 1% lower the next year. So, we put a lot of people into those loans thinking rates are going to go down, the next year.
Right.
And then they didn't, so we have to be prepared. Like, what are they, and when we qualify people for those, we have to qualify them with the full payment.
Right.
Because we want to make sure they're not getting themselves into trouble.
Once that 2-1 goes away.
Once that goes away, Now, I have had situations where, like, maybe the wife who was staying home with the kids until they were a certain age, and then she was going to go back to work.
Right.
Well, they'll have two incomes. Totally makes sense. When the payment rises, and instead of having 2% lower than the market rate, they have 1% lower, then, hey, you know what? They're in good shape because they've got a whole nother second income coming in.
Can you take that into consideration when writing the loan? No. Okay, so that's not something that's
yeah. I mean, we can't, in that case, we can't say, you know what, she's going to get a job one of these days. What if she doesn't?
I'm just thinking maybe if she had like a long work history or something, and then the baby came, and then she was going to get right back to it. If there was some sort of,
if she was on maternity leave, yeah, we can account for that. What we can't do is just, they straight up quit their job and they've been off for a couple of years. Whatever, and they haven't gone back to work yet, or they don't have an offer letter for going back to work. We can't count that.
Gotcha.
Because what if they change their mind?
Yeah, true, yeah.
So, yeah, I mean, we have to kind of watch out for buyers sometimes, like, hey, we want everybody that is able to be able to buy a home for family stability, for putting down roots, for building equity, for, where are they going to be in 5 years? That's always a big question.
Sure. Yeah.
Like, hey, sir, okay, you want to buy a house? Well, where do you want to be in 5 years? Are you going to sell this place right away? Are they carrying you out feet first? How's this working for you?
Right.
Where does it play into your wealth down the road?
Exactly. And you brought up a good statistic the last time that we had a show, which was that when you look at the average net worths of people that are hitting retirement age, the net worth on average of somebody who owns a home as compared to somebody who has rented their whole life is 20 times higher than that of their counterpart. So, a lot of people will say, oh, the home buying process, it's not part of the American dream anymore. The American dream has changed. And I will just say that the American dream hasn't necessarily changed, although it has modified itself a little bit. And, maybe for you, home isn't a white picket fence and a 3-bedroom, 2-bathroom with 2.5 kids and a golden retriever, as you say sometimes.
Right.
Maybe it's a condo downtown. Maybe it's a sleek little, townhome somewhere in a trendy part of the area. But either way, the point is, if you buy a piece of property, you make your monthly payments towards it, you're going to, over time, build equity in that property. That's going to give you the flexibility to do more. And at the end of it, you're not going to have a payment. A lot of people say, well, buying a home, I'm going to pay $200 more than what I pay for my apartment. And it's like, yeah, well, let's think about that for a second, because you're going to get a lot more space. One, you're not living in an apartment and, crammed in, which if that's what you're into, I guess maybe that's okay. But sure. I think most people, as we get older, we want to have a little bit of space. But the other thing is, can you guarantee that apartment's going to keep your payment the same for the next 30 years? Because if you look at rents from 30 years ago compared to today, they look a whole heck of a lot different. So when you think about, okay, yes, obviously insurance can change and the tax value can change and stuff like that, but your principal and your interest never change throughout the entire life of the loan. Right. So yeah, you might be paying a comparable amount or maybe even a touch more if you buy a house as compared to renting now. But let's go back and have that conversation 5 years from now, because it's going to be your rent payment for that same apartment is going to be a whole heck of a lot higher than your mortgage payment for this home now, and you're going to have built no equity in the process. And that's what I always kind of want to, stress to people, that you're not just throwing money away to a mortgage company. You are, yes, you're paying interest, you're paying taxes, you're paying insurance, but you're doing that with rent too. You're just doing it for somebody else's mortgage.
Right.
and you're not benefiting from the equity.
And I think that's what a lot of people don't, a lot of our society sometimes thinks fairly short term.
Yeah,
What can I get right now? An apartment's an easy one,
sure.
except that it isn't, because you got to have a full first month's rent, a deposit, which is often equal to 1 month's rent.
Yep.
So I mean, there's a cost to get in. And then when you get out of it, before you can rent that next apartment, you've got to have a deposit. Sure, it's coming from the old one,
Right.
but you don't have it yet. So you have to put the deposit down, you have to put the rent down, and you don't have any equity to fall back on. If you live in a house for a couple of years, you sell it, you have equity, you get some money, you've made money on it. And
Right.
so you have
you
money
can
to
roll
put
that
into
into
the
the
next one.
next, or
We have some friends that have moved around a little bit, and they've, over the years, they've just rolled the equity into the next one and the next one and the next one, where they're putting, 30%, 40% down,
exactly.
on the next house. And it totally makes sense, because at that point they made that money in that appreciation on homes, especially since COVID. I mean, holy smokes, values have gone up. But let's just say in the next 5 years, if we're seeing 3 to 5% appreciation, what's that over time? 12, 15, something like that. So your house increased in value, but also your balance on your mortgage went down.
Yep.
And people, a lot of people have a car payment, right? Everybody's got a car
Sure.
payment. And you could see your balance goes down, over the
With the
3
value
years,
of the
5
car.
years, unfortunately, with the value of the car. But on a home, it's different. The value is appreciating. And at least here, we've only seen a decline in value 1 year out of the last 30 or 40 years. And it's, it was 1983 during oil crash. Every other year, it's either appreciated or at least stayed the same.
Yep.
And so you're going to get that appreciation. And so you end up with kind of it's kind of going like this. Your balance is going down, your value is going up, and this gap in the middle is the equity that you have.
Yep.
And so even if you're buying your first starter home, or maybe you're buying something smaller than what you think you'll need 5 years from now, I don't know, if you're in your 20s, you might not be thinking about kids.
Right.
Like, heck no, I don't want to do that ever. I mean, heck, I'm almost 50. I think that myself, and I've got 4 of them. But anyway, let's just say, that's your thinking. And, all right, great, buy the first one, build the equity.
Yep.
If the rate comes down, you can always refinance into something. There's a cost to doing that, of course, but let's at least look at that.
Sure.
And see if it can save you. And if it can, great.
And I want to revisit the buy down discussion, because I want to try to make the conversation real for people where they can apply it to their actual life. So let's just take this market as an example. The League City, Friendswood, Clear Lake area of Texas. The average home price, you're looking at about $350 to $400, depending on the area. So if I'm buying a home 5% down on a conventional loan, and I want to do a 2-1 buy down, what will that cost me to be able to do that? And the reason I ask that is because I then want to go into the discussion of what are we seeing, you and I both, most sellers contribute to a buyer at the closing, and is that enough to actually have the seller completely cover your interest rate buy down?
Well, and that's a great question, because there's 2 types of buy downs, to be clear. There's a permanent buy down where you pay an amount. Usually it's 1% of your loan amount, right? Is a point, drops your rate about a quarter point, right? So, and so that's a permanent buy down for the whole 30 years.
Yeah.
And then what we're talking about is a temporary buy down. And so it's not an adjustable rate mortgage. That's often a misnomer. But, that temporary buy down might be, 2-1, 2 years, right? So it's, it's 2% lower the first year. It's, 1% lower the next year, and goes to the regular locked rate. So if the rate's 7 today, let's be clear, that's 5% the first year, 6% the second year, 7% year 3 and on. So that might be 10 grand to round easy numbers on a $350,000 house. So if you're buying a $350,000 house, and you're doing negotiating, you can get $10,000 out of the seller to cover that. And here's the thing about the temporary buy down that's good, which is, let's say you do a permanent buy down, you pay 1% of your loan amount, you save, I don't know, $60 a month, whatever it is. on these programs, you're saving like $200 and $300 a month,
Sure.
or $400 and $500 a month, depending on the size of the thing. And the way it works, we take that money that's paid, that 10 or 12 or whatever $1,000, the seller has to pay for it, seller contribution, and we put that in the account, and we're supplementing that payment. So if your payment's $1,000, maybe you're only paying $600, and we're paying the other $400 out of this account that we put that $10,000 or $12,000 in. Well, let's say somewhere in that process you decide to refinance. Okay, no problem. Whatever's left in that account gets applied to your mortgage balance. So if you owe $100 and there's, I don't know, $6,000 in there, now you owe $94,000.
Right.
And so that's the advantage of the temporary versus, but as I was saying earlier, we do have to always make sure, make people aware, hey, your payment's going to be this to start with, but at some point it could go to this.
Right.
But the beauty of the temporary buy down program is the worst your rate, if you're locked at 7, the worst your rate's ever getting is 7.
Yeah.
If rates for whatever reason went to 9%, you're good.
Sure.
Because it's never going higher than 7. But let's say rates go down to 5, and the first year, again, they're 5%. Maybe before that 6% jump, you refinance at 5. You're at 5 there on out.
Exactly.
Yeah.
And you have the seller pay for that in most instances because, $10,000 concession on a $350,000 or $400,000 house is completely in line with what I'm seeing in this area.
Right.
And that ties back into the conversation of interest rates because you don't see those types of concessions happen when the rates are 2 and 3. So you have to be mindful of all the factors. And I think a lot of people kind of get their head in the sand a bit when it's just tunnel vision, interest rate, interest rate, interest rate. And that it's going to be a good time to buy a house when interest rates come down, and it's a bad time to buy a house when interest rates are up. And it's not that simple because it can actually be a lot more beneficial to you to buy a house where the rates are today for it to make sense for you to build equity, for you to begin to build your nest egg in the form of the equity from your house, as well as buy something for a price that's a little bit more reasonable and more realistic and in line with what the market should sell the home for, as compared to getting into a buying frenzy with a half dozen other people and overpaying for a house. So there's a lot of things to consider, which the topic of today's discussion is it a good time to buy a house now, or should you wait till the rates come down? I think everybody has to make their own individual decision, but I think that, as you said, it's always a good time to buy a house if you can find a good house that you can afford the payment and it's in a location that you think is good and is going to appreciate over time. You're never going to go wrong with that.
And at one point, it's always a good time to have the conversation.
Exactly.
I think that, what do we say, 62% of America gets their news from social media?
Yeah.
Like Facebook, Instagram, YouTube, that sort of thing. And, okay, that YouTuber is telling you, okay, you borrowed $10 from dad and it becomes $1 million 3 days from now. Like, how did that happen?
Exactly.
And they're watching this stuff going, what? Wait a minute, I can do that. And that may not be a reality, first of all.
Sure.
But to sit down with a mortgage professional or real estate professional, have those conversations and talk about what's really possible.
Right.
Does it take 20% down to buy a house? As we've talked about before, the answer is no. Should I wait for rates to come down? Well, that sort of depends. What's your current situation? If you qualify now, it's probably smarter to buy now while the getting's good, while there's not, sellers are a little more incentivized, won't say desperate, I'll say incentivized to unload their house now as opposed to when 15 people. A good example, a neighbor across the street put their house on the market for just under $300,000, which in this neighborhood, it was unheard of, right?
Yeah.
And so we were all like, what a jerk, man. What is he doing to values?
Yeah.
Yet, sure enough, there are 24 offers on that house.
24 offers.
24
I can
offers.
imagine,
Yeah, it sold for like $60,000 or $70,000 more than he listed for.
Wow.
Brilliant.
Yeah.
It's like, oh, that's great. And why was that? He priced it right, and was motivated to get rid of it, right? Well, that's what we saw in 2020. Every house was like that.
Yeah.
And they weren't under market. They were priced basically at the market. But people were still paying, $10,000, $20,000, $30,000 over. And the sellers were not giving up anything.
Yeah.
They're not giving away closing costs. They're like, oh, you want us to make some repairs? Too bad. The next guy doesn't.
Exactly. Yep.
and be like, yeah, whatever, we're going to make your life hard until you back out of the contract, and we're just going to sell to that guy.
Exactly, because he'll probably pay more anyway. Yeah, I mean, that's the
It's a bad mentality. But
there's so many factors to bring into consideration when buying a house, and that's such a good example of what happens when the rates do go to 2 or 3, which I don't think we're going to see that again anytime soon. No. There's got to be a global pandemic alongside money printing. That's
Federal Reserve buying billions of dollars worth of mortgage-backed securities every month. Like, that's all got to happen again. And it's unlikely that would ever happen again. So, and if you're waiting for it, you're paying a lot of rent. I want to be your landlord if you're waiting for that.
Exactly.
Because I'm going to be a rich guy by the time that happens. But I don't want that for, I don't want that for Americans. I don't want that for people. I want them to be able to have a home and raise a family if they want to. And, if they want to just have a dog, hey, that's it. But the home ownership benefits are so great over time that I think people, they don't take the time to think about that. And, you and I, if somebody comes to us, we've talked about this before. Like, if you don't buy a house today, it's okay. I'll be here next week or next year.
Exactly.
I often tell people, I'm not smart enough to get out of the mortgage business, obviously. I've been here so long.
Yep. And I'm not smart enough to do anything but sell houses. Right. So, I'm right there with you.
So you need to find somebody. Hopefully it's us, of course, right? We do have that.
Yeah.
But you need to find somebody who's knowledgeable and who has that mentality that we're not going to pressure you into buying something. That you're not ready for. Long term, that's a bad idea for everybody.
Yeah, and like you said, it might not be the best time to buy a house for your personal situation right now, but it's always the best time to have a conversation.
Yeah,
because a conversation costs you a sum total of $0.
Yeah.
Call me, call you, if you want to talk houses, you want to talk about the Houston market specifically, which is what I know best. Sure. We do that. If you want to talk loans, call you. And worst case scenario, we determined that now's not the time. We had a friendly conversation, and you can, if credit's the problem for them, you can set them on a path to cleaning up their credit score. If down payment's a problem for them, I can assist them with some ways that they can save some money and work on some things like that. So, it's not just like only call us when you're ready to buy a house. I'm in this for the long run. You are too. Call us no matter what part of the process you think you're in. Yeah. And then we'll determine, is it the part of the process that you actually are in, or are you somewhere? Because I can't tell you how many people say, well, I don't think I'm really able to buy a house right now. And then we dive into it and they're more than capable of buying a house.
And it's not even, we help them determine.
Right.
I just talked to somebody, I talked to several customers today, as we do every day, right?
Sure.
And, one of them, that guy's not buying a house for a year or two. Mm-hmm. There's no way. His credit is not great shape. He has $7 to his name. Not kidding. That's what his checking account. Yeah. Like, hey man, okay, we got to figure some stuff out here.
Yeah.
And then you're a buyer. Got another one who's got 2 houses to sell, and they are going to make enough money to pay cash for a house here if the timing works out right. Okay. So I talked to them about 5 different ways they could come up with the cash to pay cash for this house and not be contingent on selling the other 2 houses.
Yeah.
Or for that matter, they want to just go with a regular mortgage anyway. And so several different options. Our job isn't to tell them what to do. Our job is to help them understand and teach them along the way. Like, hey, these are some options you didn't even know existed.
Exactly.
And then they can make the decision. They can be empowered to do that.
Absolutely. And I want to ask you one final question, because we did mention that the Fed Reserve meeting is coming up on the 18th. What is your prediction for what they're going to do with rates?
Well, I don't see my crystal ball around here. So, and the reality is that everybody thought one more cut before the end of the year. It's going to be a quarter. It's December 18th.
Yeah.
That's what it is. But the economy, we had an election.
Yeah.
Which did all kinds of things to the market.
Oh, yeah.
We've got jobs because of, natural disasters, job markets that are all cattywampus. And I got to say, like, I'm leaning towards, yes, we're going to get a cut. But, just like the market now, it's probably 55-45.
Yeah.
It's 55% chance, they're going to cut, and a 45% chance that they're not. And you know what? Right now, the market is pricing that in anyway.
Right.
So it's almost like a nothing burger, unless it comes along with, 10 other financial reports that say the economy is doing well or not. And all of those numbers matter. All of those reports matter that we get on a daily basis. Today it was job openings, came out today, and it was better not for rates, but for the market, better, than expected. And so that had a little bit of effect. Maybe some, I don't know, Biden pardoned his son today. So that had something to do with, I don't know what, but it was mentioned today in the
Somehow it
economic
affects the
news. I'm
mortgage
like,
market,
okay, whatever, but my thinking is, we still are more likely to see a quarter cut than not.
That's my prediction too. I think we're going to see a quarter of a point cut on December 18th.
Yeah.
And I don't see my crystal ball either, but I think that's going to be my final guess for now if I was a gambling man.
Right. Yeah.
Well, cool.
That's where I am.
Well, thanks guys so much for watching this episode of Two Guys Talkin Houses. We try to provide real information that's helpful to you in your home buying or selling journey. I'm a licensed real estate agent in the state of Texas. Mark is a licensed loan officer in the state of Texas. If you're looking to buy in this area, we'd love to help. We also have a great referral network, and we'd be happy to get you plugged in with one of our partners anywhere across the country. So don't hesitate to drop us a comment, send us a message. We look forward to hearing from you. See you next time.